Gaurav, welcome back after the break. So
Yes,
we'll
भैया.
continue now.
Okay.
So we had taken a pause at we covered these investment objectives and then no, we where we left. Compounding effect we covered.
वो भी हो गया था भैया नीचे वाला इन्वेस्टमेंट ऑब्जेक्टिव्स भी हो गया था. This person from personality, I think.
Yeah, investment objective we done.
Mm-hmm.
Now personality.
Personality.
Peter Lynch, one of the greatest investors of all time, has said that the key organ for investing is the stomach, not the brain. In other words, you need to know. Okay, wait a minute. Vishesh, come join in. Yeah. In other words, you need to know how much volatility you can stand to see in your investment. Figuring this out for yourself is far from an exact science, but there is some truth to an old investing maxim. You have taken on too much risk when you can't sleep at night because you are worrying about your investment.
Invest.
Mota moti, broadly speaking, he is talking about risk appetite that every person has. Some people want a very flat kind of returns. They don't want risks. They say, okay, I'm happy with lower amount of returns, but I do not want any risk. अपने को रिस्क लेने का इच्छ नहीं.
हाँ भैया, बिल्कुल risk.
And somebody say risk है तो इश्क है. Somebody say okay, risk, if I am ready to take risk but I need higher return. So there are different spectrum. So again, you cannot say somebody is right or somebody is wrong, which is the middle path. It's very difficult to define, but your investment decisions are for you. They might not be true for somebody else. So you have to know where you feel comfortable. So key
Yeah.
organ is stomach, means आपकी कितनी हिम्मत रहती है, how you feel about fluctuations in your trading, right? Or your fluctuation in your net worth because of valuations going up and down. Okay, so
Okay.
it really depends. Another personality trait that will determine your investing path is your desire to research investment. Okay, we already covered this, right? We already covered that. Okay, somebody, in my case, I am not ready to put or dig into financial statements. Although I am very well learned to understand all those numbers and all, because this is why my two financial degree come into play. But I really don't like reading into annual reports and digging into these financial records and all. So an important fact about investing is so we all got now preparing for contradiction. Just as it is difficult for a psychologist to predict with 100% certainty how a single human mind will react to a particular circumstance, it is difficult for financial analysts to predict with 100% certainty how to market or a large group of humans will react in certain news about company. So this phrase within the bracket, a large group of humans. So what I decide or how I act is an individual act, right? But when let's say thousands of people react at the same time, it is market behavior, how market is behaving. During COVID times, we saw everybody is running towards certain things. Everybody wanted web
Pharma
cameras.
shares.
Everybody
Okay.
wanted some pet. Everybody wanted some kind of kitchen garden. Everybody wanted some rooftop garden. So there was a market behavior. Tendency was going into certain direction. Everybody wanted certain kind of furniture. So everybody wanted certain same kind of entertainment or something like that. So a different how market behaved, how thousands of people collectively behave, is what market decides. Okay, how price is formed. Like there is a market where on one side there are thousands of suppliers, on one side there are thousands of buyers. So they are negotiating. Yeah, yeah, wherever they agree on the prices. But this is what market is. The market forces on buying side, on the supplying side, the buyer and supplier. That is how markets are formed, and price is decided where they agree to transact, right? So for a psychologist, how an individual is going to behave is difficult to predict. And for an investor, how markets are going to behave, it means collectively how thousands and thousands of people are going to behave is always difficult to predict, and nobody can predict it with 100% of certainty. Okay.
Okay.
Economists, academicians, research analysts, fund managers, and individual investors often have different and even conflicting theories about why the market works the way it does. Keep in mind that these theories are really nothing more than opinions. Some opinion might be better, though though out than others, but at the end of the day, they are just opinions. So broadly, here I want to say that although some people, some great economists, award-winning global fame, some analysts who might be a local TV analyst, who might be some kind of analyst with a research firm, some individual analyst or some SEBI registered analyst, whatever. He is also crunching those numbers. Some individual investors like me, I read about some company and then form an opinion. So this is still an opinion. Nobody can give it with 100% certainty. Even most learned economists or some analysts, they cannot guarantee that okay, this is how going to happen, because future is always uncertain and how people are going to behave is always uncertain. Even with all the uncertainties that govern the world, the socio-political, the political situation, what might happen, and then the things like COVID, etc., that we saw, health emergencies, and also
Yes, sir.
nothing is uh, nothing is certain. But at the same time, nobody whatsoever can predict future with complete certainty. They can give you informed opinions, they can give you a lot of insights, but nobody can give you a short uh, uh, glimpse into future that okay, this is how it's all going to unfold. Okay.
Okay.
Example of how contradiction play out in the market. Sally believed that the key to investing is to buy small companies that are poised to grow at extremely high rates. Sally is therefore always watching for the newest, most cutting edge technologies, and typically invest in technology and biotech firms, which sometimes aren't even making a money. Sally doesn't mind because these companies have huge potential. Okay. So some people like to invest in startups. What they
Yes.
say, okay, I'll just put 50 lakh rupees and I'll get 2% stake in this startup or 5% stake in this startup. And so there is a risk because they do not have any concrete product as of now. They do not have any
Past records.
market share, or they do not have good competitive products or a big management backing as of now. But potential is huge. They think, okay, if this becomes hits, then their money might be getting 10 times, 20 times. So what the 50 lakh that they have invested, maybe in 2 years time that can grow to be 10 crores. It can go up to 20 years. So that is a very risky investment. That is kind of a venture capital thing that is doing. So that is one part of thinking in our imaginary person situation. Sally believes so that okay, she is ready to invest in new age technology companies or biotech companies which are doing some kind of bringing in something new. Typically, we can call them startups. John
Okay.
isn't ready to go spending his hard earned dollars on what he sees as unproven concept. He likes to see firms that have a solid track record, and he believes that the key to investing in buy good companies that are selling at cheap prices. The ideal investment for John is a mature company that pays out as a large dividend. So Sally was ready to invest in companies like Ola, Byju's, Flipkart, etc. And John says no, he wants to invest in good proven record. He wants to invest in Hindu Unilever, Pidilite, Hindustan Lever kind of companies that he knows that okay, they have a strong business model, they have a history of several decades and very strong financial backing, and also he is not ready to put in his money into risky assets but into safe companies or safe assets. The ideal investment for John is a mature company that pays out a large dividend, which he feels has high quality management that will continue to deliver excellent return to shareholders year after year. Okay.
Okay.
So
Yeah.
John is also having a different thought process. He is right in his place, and Sally is also right in her place. The answer is neither. Which investor is superior? The answer is neither. Sally and John have totally different investing strategies, but there is no reason why they can't both be successful. There are plenty of stable companies out there for John, just as there are always entrepreneurs creating new companies that would attract Sally. The approach we described here are those of the two most common investing strategies. In investing lingo, Sally is a growth investor and John is a value
Value
investor.
invest.
Okay, so Sally is betting on growth, that some company will have superlative growth. It will grow at an exponential proportion. And John is value investor. He is ready and happy to invest in a steadily growing company which is having a constant growth. So somebody in an American scenario, that person would be investing in let's say
Microsoft.
McDonald's,
Okay.
which has a very diversified, not diversified, but well spread out business. But their business model is very stable, and the amount of growth that they are seeing is not exponential. Then the room for growth is also not very high. But then again, they are consistently profitable and they have history of several decades. So a person like John is feeling very relaxed and happy to take a ownership in that company. Okay, so now type of investment here we are referring to in different investment vehicles that we do. Bonds group under the general category called fixed income securities. So in Indian scenario, we can call it bonds or fixed deposits with banks, etc. So when we deposit it into bonds, they are called fixed income securities. Fixed deposits, bonds, government bonds, RBI bonds, Kisan Vikas Patras, and all these, or various kind of corporate bonds. They give you a fixed amount of returns, tax-free bonds, etc. So these are different bonds terminologies that we use. So they are offering you fixed returns
Fixed
at the end
return.
of year, or at the end of every quarter, at the end of 6 months, or maybe at the end of 5 years, whatever. So at depending on their tenure, they give you a fixed amount of returns. And second is stocks, the typical investing that we call. Okay, the
Okay.
active investing is ourselves. Stocks, when you purchase stocks or equities, you become part owner of the business.
Business.
So if you buy 100 shares of, let's say, Pidilite, then you are part owner of that. Maybe 0.00001% maybe you're holding, but then again, with those 100 shares of Pidilite, you are owning a part of, very minuscule part of that company. Mutual fund. Now mutual fund is a collection of stocks and bonds. When you buy a mutual fund, you are pooling your money with a number of other investors, which enables you to pay a professional manager to select specific securities for you. This we have covered already. I'll explain you again. You want to invest in Indian equities, and your idea is that, okay, I want to invest in blue chip companies.
Okay.
So now the one way for you to, you kind of select different stocks, and then you filter out which you think are the big companies, which you think are the blue chip companies. Then you may ask
What
uh,
is
5-10 knowledgeable people about what they think is the blue chip company. You might refer to media publications and TV channels, etc., who they recommend, who they classify as blue chip companies. And then you say, okay, now I have identified these companies. Then you might say, okay, I'll invest in these companies in this proportion. Let's say you have found out 10 different companies. You have found out Reliance, TCS, Infosys, Hindustan Lever, ITC, State Bank, Axis Bank, HDFC banks, and all these kind of 10, 12 companies you have identified. Now you don't have much idea in what proportion to buy each company, and how when to enter, when to exit out of these companies and all. So how do we keep a track of this? So a professional agency, a mutual fund agency, what they do, they say that, okay, we have professional managers who are well qualified professional manager, money managers, professional managers. So they will invest in blue chip companies. So they launch a scheme, mutual fund schemes, which is, let's say, called XYZ blue chip scheme, blue chip
okay?
investment schemes. So now what you do, you have 10 lakh of investment money, then you go and go and invest, or you buy in. So how you invest in mutual fund? How you invest in mutual funds? You buy mutual fund units. So what they do, let's say they invest 10 crore rupees on your behalf, and they divide that 10 crore rupees into units. So let's
Okay.
say each unit is worth 1000 rupees. So you can invest your money into multiples of 1000 rupees. So that also gives you an ease that you can start with a very small amount. and it is so easy for you. Let's say somebody is having 50,000 rupees. How difficult it is for a person to divide that 50,000, small amount of 50,000, into 12 different things.
Companies.
But a person with 50,000 can easily buy mutual fund units.
Okay.
And also that professional manager who manages mutual fund money on your behalf might be very well equipped to understand the nonsense of equity markets, and he or she might be making better decisions on your behalf than you would actually do, and you will be saving on time, efforts, and lot of other difficulties, and you need not even dig deeper or apply your mind too much into selection of securities. So this is how mutual fund will help you in a good way. So all those people who are not very well versed with financial market, who do not want to invest time into it, or who, who might not be able to have a very vast understanding of this because they might not have very good educational background with them, and still they want to invest their money, I always recommend them to invest in mutual funds, because at least if you are, even if you are paying a fees to a professional, at least what's the harm in that? What's the harm in that? That professional is charging you fees for the professional services rendered, and he might do a much better job than you would do while doing
By
it for
your own.
yourself. You might burn your hands on the learning curve, but that professional might be doing an excellent job and will justify, and that probably justifies paying him a small amount in the name of management fees. So for those, I always recommend mutual fund as an investment. So before going to break, before going into break, we discussed about passive style and active style. So somebody who invests his money in mutual funds, and let's say he goes for a monthly investment plan, or a systematic investment plan, which are popularly known as SIP, for systematic investment plan, or monthly investment plan, MIP also called, it is called. So when you are at certain period, we are investing money, or we are investing money in one go, but then again we are waiting for that money to grow for over years. That is passive style of investing. Somebody who is keeping a track on each and every company, analyzing their quarterly performance, reading annual reports regularly, and concentrating on news flow, that is an example of active investor. That is an example of active investor. So mutual fund, somebody who wants to be a passive investor and still wants to participate in different kind of mutual fund schemes, which are might be investing in blue chip schemes, growth companies, this and that. So mutual funds offer different kind of schemes for different requirements. So you must have seen that advertisement on television channels, mutual fund sahi hai. So they say
Ah,
that go to the site mutual fund sahi hai and get investment knowledge about it. So they are not wrong as such, because if you want to invest your money passively, then at least it's a reliable start point. It's a reliable start point. You go and understand the basics, and depending on your requirements, you invest your money into mutual funds, and your money is managed by professional managers. So there is a good chance that they do a good job with your money, and it's better than investing it yourself into markets with limited knowledge or no knowledge of it. Okay. So
okay.
now, alternative investment. Alternative investments are options, future, forex, gold, real estate, etc. Some of them are just speculative vehicles,
Okay.
but like options and futures are derivatives or speculative vehicles. But but there are structured products around those things which make them an investment vehicle. So a speculative vehicle can be made into investment vehicle. I'll give you an example. So these are popularly called alternative investment options. So SEBI has one product called alternative investment funds, AIF. So you
Okay.
can also read about AIF. You can Google and learn about what is alternative investment funds, what is AIF. Now I give you an example of alternative investment fund options. So there is a thing called arbitrage funds. Arbitrage funds, what they do, let's say there are two markets. One is derivative market and one is spot market. Let's say
Okay.
currency derivative market, where rupee to dollar is at a rate of 82 rupees. Like rupee and dollar are trading at 82 rupees. That means 82 rupees means $1. That is the current spot market. And future market, that is today we are talking on July month. let's say I'm talking of December month, 6 months hence, the rupee dollar exchange rate that I am offered is 84. 84. So somebody who buys 80 dollar at 82 now, dollar at 82 rupees now, and sells it at 84 6 months hence, that person is making 2 rupees premium, and that is roughly about 2.5% for 6 months, right? There is no
Okay.
risk involved as such. You buy now for 82 and sell it for 84. You are selling it now, like your price at 84 is locked already. So your profit of 2 rupees is locked. Your money will stay invested for 6 months, but your amount of 2 rupees is locked. So
Okay.
although he is buying into spot market, selling a futures contract, but the 2 rupees is already locked. Prices go now, rupee dollar may go anywhere, but his 2 rupees are locked. So somebody who is investing into this kind of investment, although that person is typically dealing in a derivative product, that person is typically dealing in a derivative products, but such investment is such a thing is still an investment. It's not speculation where a person is getting a consistent return out of such things. So there might be some risk involved, but more or less it is a investment vehicle. And such investment are called alternative investment, because they are not typical investment like investing in bonds or securities directly, but they are like kind of curated kind of products that act as investment vehicles. So there are some vehicles in gold as well, like people are investing in gold bonds, where government is not giving you physical gold, they are going you gold bonds, which will have the same price as the physical gold, and also they are giving you a fixed interest of 2.5% per annum. So this is also an alternative investment kind of thing. You are not getting physical solid gold in your hand. And there are some real estate funds where you are collectively investing in a real estate project. So unlike you are owning the whole building, or some physical part of that building, you are actually holding units into that real estate project and kind of thing. So there are different kind of things that are possible in an alternative investment scenario. Portfolios and diversifications. A portfolio is a combination of different investment assets mixed and matched for the purpose of achieving an investor's goal. Items that are considered a part of your portfolio can include any assets you own, from real items such as art and real estate to equities, fixed income instruments, and their cash and cash equivalents. Okay. So when we
Okay.
talk of portfolio, basically it means anything physical, non-physical, in your digital form, and even it. See the interesting part. It also consists of your maybe art paintings which cost you a lot and all. So that is also your investment into diamonds, or your investments into some kind of precious stones, or some kind of collectibles. That is also your investment portfolio. Your some people I heard they like to invest in some luxury watches. They say it's a good investment. I bought this watch for 1 million and now it's worth 1.5 million after 10 years. So they feel happy about it. Some people like to invest in physical gold. So there can be different kind of investment. So all these are part of your portfolio. So now portfolio, different kind of portfolio, it depends on how much you are investing. Somebody who is investing in fixed income, somebody who is investing in fixed income, that is called conservative. Fixed income means conservative. Okay, so conservative means okay, I don't want to take much risk. So fixed income, like I invest in RBI bonds. If I invest in RBI bonds, or if I invest in say fixed deposit with HDFC Bank, that is conservative. I don't want to take risk. I am ready to take limited returns. I am ready to take limited returns, but I want them to be very secure. I want to be more secure. So in that I can get that security I get when I am dealing in fixed fixed income products with bonds and fixed deposits, etc. So that is called conservative portfolio, where your allocation of your resources is limited to equities or other volatile instruments, and more they are more into secure and fixed income paying instruments. And then further, moderately aggressive portfolio. Moderately aggressive, where you are investing more into equities, because equities by nature are fluctuating in price. They are going up and down. So they are called moderately aggressive, or more risky kind of thing, less conservative. And somebody who is, let's say, investing all amount of money into equities, or 90% into equities, then it would be called that person is very aggressive, because Equity might see a volatility of 30,
Yes,
40% in their valuations easily. So I don't have slide for it probably, but like a good portfolio would consist of equities, commodities, real estate, gold, for some, if possible, some foreign investments. So maybe gold bonds, maybe some corporate bonds. So different kind. Even within fixed income, there can be separate diversification. Even within equity investment, there can be separate diversification. Some amount you can invest directly, some amount you invest through mutual funds. Some people want to invest their equity portfolio into startups, etc., hoping that they might get some 1:20 kind of returns. And also within equities, within fixed income, there can be different kind of classification. Within investing into precious metals like gold, it could be physical gold, it could be in form of jewelry, it could be in form of gold bonds. So even there they can have different kind of classification. Even kind of cash, it can be hard cash, it can be cash kept in some flexible accounts. It could be some kind of cash deposits that you keep with your brokers, or in it, or in liquid bees, or it could be cash that you are keeping as foreign currency notes. Like some people I know, they always try to keep some $4,000 with them. So it really depends how you want to keep your money. In all centers around diversification, different securities perform differently at any point of time. So with a mix of select types, your entire portfolio does not suffer the impact of decline of any one security. When your stocks go down, you may still have the stability of the bonds in your portfolio. Why diversification is important? It is really just the simple practice of not putting all your eggs in one basket. If you spread your investment across various types of assets and market, you will reduce the risk of catastrophic financial losses. It is so easy to understand. Don't
yes,
put
Bhaiya.
your money into one asset class. Even I would suggest investing all your money in bonds is not good, because you are dealing in bonds through SVB Bank, and SVB Bank goes bust, and all your bonds, etc., that you were buying and hoping for a fixed return have gone bust, because the counterparty risk is there in those. So nothing is too safe. Just that within given the scenario or safety parameters, you make an assessment and make your investment decisions. So this is about it. Gaurav, I would suggest you to go and reread about it, and just don't
Okay, Bhaiya.
rely on whatever I'm teaching you. Investment or investing process is a very vast subject. As as I was telling you earlier, keep on reading about various investment options available, different vehicles, and what is going on in the market, because this area is so dynamic that different things keep on coming, different options for investing keeps on coming. So keep learning and uh, uh, keep getting the diverse knowledge about it, so that you have a better career ahead of you.
Okay, Bhaiya.
Okay, son.
Okay, Bhaiya.
Okay, take care. Enjoy your weekend. We'll meet
Yeah.
again. We'll discuss over the phone and we'll take it forward. Okay?
Okay, Bhaiya. Bye.
Okay, take care, son. Bye bye.